Welcome to This Week in Money. I'm Jim Goddard. Today, Victor Adair from PI Financial believes the U.S. dollar will remain a safe haven in tough economic times. Real estate consultant Ross Kay is very concerned the government may be using seriously flawed real estate statistics. We talk to Victor Adair right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Victor Adair, Senior Vice President of PI Financial in Vancouver. Welcome to This Week in Money, Victor.
Well, I'm glad to be here.
It's been a while since you've been on the program, but nice to have you back. Right now, the markets are in a very interesting place. I likened it the other day to an airplane where you have a service ceiling where maybe you get to 25,000 feet. But here we're trying to, every day we kind of get an extra foot or two. We flutter off and get a little higher again. Is that where we really are? A place where we could just flutter out, maybe spin out if we're not careful?
I imagine you're talking about the stock market.
Exactly.
In North America, the major indices here are at all-time highs. I've just noticed we've had a monthly key reversal to the upside in the S&P 500. This market has been very strong. It's drawing capital, I think, from around the world. And you can certainly see that in the foreign exchange market where the U.S. dollar is at its best level in nearly a year. This is the U.S. dollar index, while the euro currency is at the lowest level it's been in a year. One of my main theses, Jim, is that capital is coming to America for safety and for opportunity. And I think, if you watch where the money goes, that helps you understand why things are doing what they're doing in the market.
Is that good news for the Canadian dollar? Because we always compare it to the U.S. dollar.
I think let's answer that this way. As Canadians, we've seen our dollar down at 60-odd cents back 12 years ago or so. We had a rally to all-time highs in the Canadian dollar. Really, it's not been about the Canadian dollar. It's been about the U.S. dollar. I would say this for my own savings. I have, over the last few years, converted about 30% of my net worth into U.S. dollars out of Canadian. I still obviously have 70% in Canada. I live here, I pay my bills here and all that. But I just couldn't see it where it made any sense to have all of my money in one currency. I should have some diversification on that front. And I was given a gift to just being in the right place at the right time when the Canadian dollar made this huge rally. Now, your question was, is it good news for the Canadian dollar? Well, I mean, it'd be good news for Canadian exporters. I expect that the major commodity bull market that we had from roughly 2001 to 2011 is either taking a breather or it's over, and I would look for the commodity currencies to trade lower. Specifically, the Canadian dollar made a low earlier this year. I'd look for that low to be taken out as the Canadian dollar goes down a bit from here.
If the equity markets do take a big drop and people are expecting a correction, I mean, if you have your usual 4-year cycle, we're 2 years out of date. Has this really thrown a wrench into the works because this particular business cycle has lasted so long? We don't know what's going to happen and when?
Yeah, I think to talk in terms of a business cycle is very old school, as the kids would say. The past few years, the only thing that's really mattered at the margin is what the markets anticipate the different central banks are going to do. And we've had, one after the other, a lot of money printing all around the world. That money has to go somewhere, and, it'll go where there's momentum. The easy money policies, I think, have caused the stock markets to go up. Right now, we're just talking here ahead of the August, what we've got, Labor Day, the last week in August, usually one of the quietest weeks of the year. We have got the U.S. dollar, as I say, at a 1-year high, stocks at all-time highs, interest rates all over the place, very low. In Europe, we've got sovereign bonds trading at all-time historical low yields, and on top of that, The volatility in the financial markets is extremely low. I think we could have a real firecracker of a fall here in terms of a lot of rock and roll prices really starting to move.
Is this the time where the bargain hunters start to sharpen their pencils and say, hey, look, if this thing does start to drop, what big stocks should I go after and which ones should I wait for because they're good value? I just want a good price.
I'm not going to talk about individual stocks. I trade the stock market through the various indices because I'm more of a top-down trader. In other words, what we would call global macro. I have to tell you, the last little correction we had, we caught that, been waiting for an opportunity to get short the stock market again. I am just amazed at the strength of this thing, and as a trader, I really have to respect that what the market is doing rather than what I think maybe it ought to be doing. I understand the stories that say the market's overvalued and due for correction and all that, and perhaps it is, but when you look at the chart, man, this has been a very strong bull market, and if you want to be taking a shot at the short side, I think you either have to be very nimble or just very lucky.
A lot of people have been disappointed the U.S. government continued its quantitative easing for so long, and that has been the big factor. When they do stop it completely, are you anticipating a big drop in the equity markets?
There's a couple of key things that are moving markets here. One I just mentioned was central bank policy, and in terms of central bank policy, we're having the Fed move in the opposite direction of what the other central banks are doing. In other words, the European central bank looks like it has to do something there to try to stimulate the economy, where maybe in America the Fed is pulling away. Bank of Japan, People's Bank of China may also be needing to be more stimulative. The difference between the central bank policies of the different regions is going to be one of the key things that drives the market, and that is certainly one of the key things that I think and will take the U.S. dollar higher relative to other currencies. I know folks think that the U.S. government's got problems and the dollar isn't going to go anywhere and so on, but in the world of currency trading, it's always one currency relative to another, and the U.S. dollar is going to benefit as being seen as the best of a bad bunch.
What about all these moves? I know there's a trading group in BC and Ontario who wants to join the people in Singapore, London, and Frankfurt who have special trading privileges with the yuan in China. Is that where people are going, or are you kind of hedging a bet where people still have...
That's so off the radar screen. I don't have any interest in that at all.
Really? So
no.
It's one of those things that people talk about it, but it's not real? Or it's not realistic?
I don't know. I mean, it's so marginal in terms of making any difference to where the markets are over the next few months that, I wouldn't even consider it. The thing is really, what's moving the markets here is relative central bank policies and actions and geopolitical stress. We've got deflation in Europe. The Eurozone represents 20% of global GDP. Brazil is in recession. China is slowing down. This is, what is driving central bank policies. These folks are pulling their hair out trying to think what they can do to make, to do their job as they perceive it. And that will be what drives U.S. dollar higher relative to other currencies. I could see certainly a correction coming in the stock market, but I'll also say, as much as I like to trade things from the short side, I think the stock market could go a lot higher because that capital has got to go somewhere, and the U.S. stock market's going to look good relative to other investments.
We'll have more with Victor Adair next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking to Victor Adair, Senior Vice President at PI Financial in Vancouver. You were saying you're bullish on the U.S. dollar right now, and we know it's always been where people run to. And we do have what they always say, interesting times in the world. The Ukraine-Russia crisis, I think perhaps on top of a lot of minds. I don't think we're going to go to war, but what is this going to do to the financial markets?
Well, we call it geopolitical stress, and I will say this, I think geopolitical stress at least is deflationary. And Europe is already in the grips of deflation, and this is just going to make things worse. And Europe is a big part of the global GDP. We have got all-time historical low yields for the country bonds across Europe. Germany, for crying out loud, is trading at about 0.9% on their 10-year paper, compared to, in the United States, 2.3%. This deflationary pressure where we came through a credit crisis in 08, 09. We've had a bounce back. We've had all kinds of money printed since then, and to what effect? What is possible, I think looking ahead, is we'll see the Fed tightening relative to the other central banks, and I think the deflationary pressures stay there, and it's possible that the various central banks just say, hey, we've got to ramp it up like there's no tomorrow and do a lot more printing. And at that point in time, we can get a turnaround, get into an inflationary kind of market. But right now, at this time, in the immediate future, deflation is going to be the biggest worry, and that's what's going to motivate the central banks.
Does that mean interest rates are going to stay the same or are they going to go up?
That's really good question. And in terms of interest rates, what I think is that we're going to see a widening of credit spreads. In other words, does it make any sense, really, for Spain to be able to borrow at a lower interest rate than the United States? I don't think so, but, the market's driven Spanish government bonds down, and I don't mean to pick on Spain. It could be any number of, France, you get paid half of what you get paid to invest money in the United States, but putting your money in the hands of the government of France. When I look at the government of France, I don't think that's a very good idea, but that's where the markets are. So I would anticipate, for instance, that you could be a buyer of American bonds and a seller of French bonds, and you'd make money on that trade over the next year or two. And when I say year or two, let me give you a time frame here. The U.S. dollar has had some big swings over the last 40 years. Under the first term of Ronald Reagan, the U.S. dollar doubled against other currencies. Then it fell back. Second term of Clinton's reign, between, say, 95 and 01, we had the U.S. dollar rally by about 50%. We made all-time lows in that index in 08, just prior to the commodity crash. And I believe that we've started a bull market in the U.S. dollar at around 2011, and I think it'll run for the next several years.
So many people say America has very little to offer in the way of industry, and yet when times turn bad, somehow America still looks pretty good.
Well, yeah, I think that goes without saying. Something I used to say is that the Americans wash their laundry in public. The Europeans don't, and the Asian markets definitely don't. Yeah, they got warts and they got problems, and you can go on the internet and find all kinds of reasons why you should hate America. But again, it's relative. Capital is going to go somewhere. It's not going to go to the moon, okay? And the place that'll be perceived to be the safest will be the United States. Now, in that environment, gold. How does gold do? In a strong U.S. dollar environment, that creates real headwinds for gold. However, if gold, and I could see this happening, does start to rise, and I don't mean tomorrow, but as we go into the next year or two, we could see gold doing better against not only the U.S. dollar, but against all other currencies, and that would be a genuine bull market in gold.
Canada, of course, is a major gold producer. Is that good news for Canada?
The amount of gold we produce isn't going to show up on the radar screen in terms of, what it does to our overall economy. Oil would be hugely more important. Canadian oil trades at a big discount to world prices. Oil markets here, very short term, certainly look to me like they could go higher. But, there's certainly a split market in oil. There's, call it safe domestic oil, and then there's oil from various hot spots or trouble places around the world, not the least of which, the Middle East. So definitely the oil is fungible around the world, but depending on where you're sourcing it, the price is going to change a lot. Oil out of Canada, for instance, is a lot cheaper than oil out of the Middle East.
Sure doesn't seem that way when I go to gas up my car.
Well, that's just relative. Yeah, I mean, we're at around, $90, $100 oil. You're probably remembering a time when oil was $30.
And, we saw that, I guess, 20 years ago now. But, I think people are used to these prices now. Is that good news for the oil industry stability?
Well, there's so many cross currents going on there. If the Canadian dollar weakens, as I anticipate it does, then maybe it makes the domestic producers of oil, gives them a better profit margin. I mean, let's back up a bit. I mean, the big taker of commodities during the 10-year commodity boom was China. And if you can tell me that you know for a fact what's going to happen in China in terms of their economy over the next year or two, you're a lot more informed than I am. But it looks like China is slowing, with reason, trying to change their economy. And it's possible that their voracious demand for commodities, to buying everything that wasn't nailed down, may be changing. And I think that's such a wild card. I wish I knew more about how things were going to play out in China, but I mean, I just don't.
Yeah. Check into their next 50 or 100 year plan.
Yeah.
Because sometimes even the Chinese don't know what their big plan is. Victor, is there a website people can go to find out more about your investing policies?
VictorAdair.com.
That's pretty simple. I like that.
Yep. Yeah, we've been running a website there for 10 years or so. I probably write a blog every week or 2 weeks to just a quick comment on what I think about markets, and we put some charts up there, so that's what we do.
After the break, real estate consultant Ross Kay on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Ross Kay of Ross Kay Realty Consultants. Welcome to This Week in Money, Ross.
Thanks, Jim. Glad to be back.
Well, this time around, a revelation about Canadian real estate statistics and what the government does with them, where they come from, and just how reliable they are or are not. And you were telling me you were shocked to find out that there's no way to second check these statistics the government runs out because they're spoon-fed them by the Canadian Real Estate Association that uses a number of different ways to compile them. There is no national standard for the way statistics are gathered about housing and real estate. What kind of an impact is that going to have? And is, for example, my house worth what the government tells me it's worth?
Well, Jim, to be honest with you, no, your house certainly won't be worth what the government would tell you what it would be worth. I'm going to go a step further. I'm going to tell you that your home is not worth what the local real estate board is telling you what it's worth. If you would like to know what your home is worth, you could call an appraiser up, and the appraiser could do a professional appraisal, which you would pay for, and they would tell you exactly what your home is worth. And you could count on it because they have no vested interest in the number that they're going to give you. Everyone else has a vested interest, and there is no requirement for them to meet any level, any standard of care, any minimum requirements in the same way that an appraisal would. So what we've been looking at right now, Jim, is before I got on the phone with you today, we've had a major concern. A few of our clients have come back to us and have questioned our numbers on how we're coming up with our average price of a Canadian home. We were challenged that our valuation of Canadian real estate is not backed up by what the government through CMHC and StatsCan is claiming it to be. That caused us to do quite a bit of research over the short last couple of days, and I'm not 100% sure as of today, but I got off the phone with CMHC before I spoke with, took this interview today, and right as of now, the representative from CMHC that I was talking to today, he could not tell me what the average value of a Canadian home is today.
Really? I thought they'd be right on top of that. Isn't that their job to know those kind of statistics?
Well, this all started, there was in August, there was a press release from StatsCan where they compared the net worth of the average Canadian against the net worth of an American. A lot of the surge in Canadians' net worth obviously is focused on real estate valuations. When I was reviewing the data for that StatsCan publication, I started to wonder where they're coming up with the asset value of real estate. I sent an email off to StatsCan, and I was lucky to have a very quick, prompt response from them. It happened in the same day. They came back and they told me they got the number from CMHC. They don't have the numbers, they get it from CMHC. Then I emailed CMHC, and things were quiet. I followed that up with a couple of other emails and a phone call, and I finally got through to someone just before I got on the phone with you today. I've spent the last 2 days, as have some of my staff, scouring Google, trying to find out what CMHC uses for its average worth of a Canadian home when they come up with their monthly reports, their Canadian Housing Observer, Housing Now, all of the reports that they issue. It appears right now, and based on all the conversations I've had with government staff or CMHC staff, that the price that they're using, generally speaking, is the average sale price of a home in Canada. The average sale price of the home in Canada that the Canadian Real Estate Association reports.
And how accurate is that figure?
The figure has no accuracy at all. There's no relevance with it and what the price of an average Canadian home is, or what the average Canadian home is worth. What you've got with the average sale price reported by the Canadian Real Estate Association that appears in every CMHC publication is nothing more than a summation of the number of sales that took place in a number of months. Let's say that it's 1,000 divided by 1,000, and you got an average sale price. Now, on face value, that might seem okay, except that there's no consistency in what composition those 1,000 homes were. So in 1 month, let's use this example. In 1 month, we take 200 homes in British Columbia, Vancouver for the sake of the argument, take 100 homes in Calgary, we take a few in the prairie provinces, we take 300 from Ontario, and we finish the lot. We take average them all together, and we come up with a price. The next month, we're gonna count 500 houses from British Columbia, Vancouver, 100 from Calgary, none from the prairie provinces, 400 from Ontario, and nothing from east of Toronto. And we're going to come up with the average price. And that's what we're going to call what the average Canadian home is. Next year, when the market in Vancouver may be slow, and the market in Calgary may have slowed down, and the market in Toronto has slowed down, we're going to take 300 homes from Manitoba, we're going to take 300 homes from Quebec, and we're going to take 200 homes from Newfoundland. We're going to add those together and come up with the average price. Obviously, we're going to see all of a sudden the average price has dropped $400,000. That's what happens with the average sale price every single month. It is not a measure that has any statistical relevance from 1 month to the next. All it is the number of homes that sold this month divided by the number, and you get the average price. That's it.
So, in other words, are they just cherry picking where they think the best statistics will come from that make them look the best?
Oh, they're not cherry picking. The market itself is cherry picking right now. You know, the three markets that are still relatively in a buyer's category or places where prices are increasing happen to be Vancouver, Calgary, and Toronto. Or the three provinces, British Columbia, Alberta, and Ontario. That's where they are. So the number of sales that are taking place in those three provinces is disproportionate to where the houses in Canada are located. So because Quebec is trading houses at about 1/3 the rate that is happening in Ontario, your average sale price is reflecting counting Ontario homes 3 times more rapidly than you do than the same house in Montreal, when you should be counting them exactly the same. So any person listening to your radio station today who hears the word average selling price or sees someone drop the word selling from average selling price and instead just use average price or average residential price, as CMHC has on its website, you know immediately if you use that number, you're being conned, you're being misled, or you're ignorant to how housing prices actually operate. So for your listeners, do not listen to any of the average sale price numbers that you hear reported.
How inaccurate do you think those numbers might be?
Well, this brings us up to, well, I know how inaccurate they are. Right now, the average sale price is about 20% higher than what it should be if you said it was what is the price of an average Canadian home. So right now in Canada, Canadians and the press are really only given access to three different numbers. One is the average selling price, and that comes from the Canadian Real Estate Association, and that's the one that gets the most play across the country. It makes headlines on BNN, CBC, Global, every radio station across the country. On the 15th of the month, when the Canadian Real Estate Association says the average sale price has increased 2.3%, it's now at $403,000, everybody believes that's what the average Canadian home is worth. Your second option is the MLS House Price Index. And what happens there is they take a very small, unique set of houses in Canada. They also happen to be, generally speaking, some of the houses that are under the highest price pressure, and they calculate an average based on that. Now, it's a complex methodology that I personally don't endorse, but that said, it is a few countries around the world do use their methodology. But the problem is, when the MLS HPI is released, it only represents a very small percentage of the actual homes in Canada. It doesn't represent them all. Terranet National Bank House Price Index, that's the third one, which is also the newest. And what it does is it uses a methodology similar to what the MLS HPI is, but it skews its data based on a percentage basis, which it actually publishes on its website. So when you go to the Terranet National Bank House Price Index, you can actually see the percentages that they use, and then if you compare that against the housing stock, you'll see the percentage they're using doesn't make any sense at all. It's out by a substantial margin, and it's skewing the numbers there as well. So right now, the three measures that Canadians have access to, average price from the Canadian Real Estate Association, MLS HPI, and the Terranet National Bank House Price Index, in my opinion, are all wrong. They do not present the average value of a Canadian home. Now, you can look into their data, and if you live in one of the cities they're talking about, you can maybe come up with a number that's representative of your city, but even there, you've got to be very careful with the data and how that they have it. So what we did, and we just went live with this last week, Jim, is we came out with the Home Value Index, which your listeners can find at homevalueindex.ca. We actually created two indexes. One is the Home Value Index, which is for consumers, thus the use of the word home. And then we've come up with a professional level, which requires a higher degree of analysis to be able to use, and that's called the House Value Index. We've separated the two in order so that consumers are not misled or consumers don't make the wrong assumption when they look at the numbers. So your listeners, they should be going to the Home Value Index, and there they can see what we have calculated is the average price of a Canadian home. We go back to from 1991 all the way through till today, and we've made that freely available on the internet to Canadians, and we've did this because when we're looking at real estate data, and we're looking at CMHC, and we're looking at StatsCan, and we're looking at how the government is coming out with plans and policies for the housing market, we see a major problem with the information that they're using.
We'll have more with Ross Kay next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with real estate consultant Ross Kay. Ross, the government is using, as you believe, flawed figures to decide what's going to happen to real estate. It has an impact on mortgage rates, on government policy concerning housing. Well, how much does real estate account for in the Canadian economy? And if they're using these skewed numbers, how much could it screw up our economy?
Well, first of all, I don't want to profess to be anything other than a housing expert. So in terms of being an economist or being an expert in either financial markets or the economy, I am not the person. I am the person who can comment on 35% of the Canadian economy that is being impacted by the housing sector. So right now, based on the latest StatsCan release, the housing sector is representing about 35% of the economy. 35% of the economy appears to be supported with the wrong information. If our calculations are correct, if the home value index is correct, I encourage anyone to look at it. We have posted how we do our weighting for each province to ensure that we're 100% accurate. We posted the weighting for the last, since from 1991 forward. If our numbers are correct, which we believe them to be, on home value index, homevalueindex.ca, then the numbers that CMHC are using are out by over 17%. Now, Jim, I'm going to give you a specific reference to this because this is what I've been in discussions with CMHC with today. CMHC, they have a chart online, the only chart that you can find, which they call the average residential price. So if you Google average residential price 2002-2013 CMHC, I'm sure that the chart will come up. If you look at that chart, it gave a value for the average residential price of a home in Canada for 2012 was $363,401. Now that number is the exact same number that the Canadian Real Estate Association released. Every single number on that chart is the exact same number the Canadian Real Estate Association released. When you look at what we have calculated the value of the average Canadian home in 2012, we've calculated that it's $327,449, or a difference of somewhere in the neighborhood of 17%. That's what we're saying. So 327 to 363, you guys do the math. When we look at this year, we know that last month the Canadian Real Estate Association said that the value of the average Canadian home, which initially they said was the average selling price, and then in their literature it turned to the average price, was around $403,000. We're saying that it's actually $344,829. So it is at $60,000, almost a $60,000 difference. If our number is true, and if CMHC simply has used the Canadian Real Estate Association number, and given that number to StatsCan, then the net worth of an average Canadian right now, right today, is $60,000 less than what you were told it was by CMHC and StatsCan.
I know they just proudly put out a news release saying the average Canadian's net worth was up 8% this year.
So if they're basing their numbers on the average sale price as reported by the Canadian Real Estate Association, they're wrong, and I will stand behind this. They're wrong, and they're out by almost $60,000. Now, when you take $60,000 on average, and you multiply that across the 10.8 million homes that we measure across Canada, it is a staggering amount of money that is not really available in the Canadian economy if in fact CMHC told the government the average sale price is actually what the average home is worth.
Wow. So what kind of an impact is this going to have on taxpayers who could be on the hook for defaults covered by CMHC?
Well, I think in that case, if you look, because the real estate market, contrary to popular belief, the real estate market has been very slow the last couple of years. As a matter of fact, 2014 is 20%, yes, 20% slower than it was in 2007. Now, let me explain this to your listeners. In 2007, Canadians were moving every 9 years and 6 months. So you would stay in your home, on average, 9 years and 6 months before you moved. In 2014, you're staying in your same home 11 years and 10 months. So you're staying in the same house 2 years and 4 months longer in 2014 than you were in 2007. So anyone who believes the real estate market is busier in 2014 had better look at how long Canadians are staying in the house, because obviously a real estate market is busier when people are moving quicker. The longer they're staying in the house, the slower a real estate market is. What you have in Canada is that you have a real estate market that is not being measured under any standard anywhere. There is no single measure of the market that is being used that describes the market the same each year. What you had in August was, for July sales, when Canadian Real Estate Association said it was almost a record month, or the second highest month, they're comparing a real estate market the size that it was in 2007 against how big it is in 2014. And the real estate market has grown substantially. The housing stock in Canada, like the number of homes in Canada, is substantially larger in 2014 than it was in 2007. So to say, if you had one more sale in 2014 versus 2007, that 2014 is a record month, it's only a record month for how much commission the real estate agents put in their pocket. It's not a busier real estate market. The flip side of that is Canadians have never been told how slow the new home market actually is in Canada. And I'm going to break another piece of news here on your station today, Jim. Canadians are not aware that from 2002 till today, every single year, the housing stock, the growth of the housing stock has reduced. From 2002, which was a record year, till today, the housing stock has grown at a smaller rate each consecutive year from 2002 forward. As a matter of fact, 2014 is the lowest recorded amount of growth that has taken place in the new housing sector since 1991.
And they keep telling us it's booming.
Sure, of course, because they're comparing a market the size of the number of houses that we have in 2014 against the number of houses we have in 2007. The two don't make sense. As a matter of fact, when you look at the sales statistics, some of the numbers back in 2002, they're comparing it against. This just doesn't make any sense. It is, whether it's the lack of the ability of researchers to look at housing data, all of the housing data, whether it's the natural progression of moving from a non-computerized way of collecting data to computerized, whether it's the fact that people who do not understand how a housing market operates are actually commenting on the housing market as if they're experts. I don't know why. But what I'll tell you is this. Throughout the 90s, when new homes, when the housing stock of Canada was growing at a higher rate than it has since 2002, that growth of the housing stock was building the economy. And it was setting us up for what's happened from 2002 forward. So as new houses are being built, your resale houses drop because consumers, generally speaking, prefer to buy a new home as their first choice. Those new homes took from 1991 to 2002 before they started to become resale homes. So once they started to become resale homes, those new homes built from 91 to, let's say, around 1999, they're a totally different style of home. They're bigger. They are on smaller lots. They have more features. They're in more wealthier neighborhoods. The demand for them is higher. They have 9-foot ceilings. They have granite countertops. They, in general, are a far more expensive property. So you have seen the surge in prices being impacted by those houses that were built throughout the 1990s. And now they're coming to market. People are moving up to bigger houses, and that's causing the average sale price to increase disproportionately to what the average Canadian home is still worth. Because you got to remember, the majority of the homes in the country were still built before 1991. So there is no reason that the value of all homes are being increased because of that new housing stock that's been added. The old homes, we still have 8-foot ceilings. We still have bungalows that were 900 square feet. We still have detached garages. We still have 60 by 120 foot lots. Those old houses, they're still the same house. You can update it, but it's still the same house. It's not a 3/4 or 800,000 or 900. It's not $1 million property unless you can tear it down and build $1 million property on it.
Like we see in Vancouver all the time.
Yeah, this is another interesting thing that seems to be missing from all post-secondary education about real estate. A housing market doesn't shrink. House prices may shrink, but the market itself doesn't shrink. Unless you live in a country where you're going to be impacted, where you have no home insurance, and then a natural disaster wipes out 100,000 homes, a tsunami hits and there's no insurance to rebuild those properties, and the homeowners can't afford to rebuild them. In a place like Canada, your housing stock never shrinks. It always grows. The only thing that matters is how big does it grow? How rapidly is it growing? And what are the consequences of that growth? We have an immigration level in this country. Immigration comes, people rent for a couple of years, and then they want to buy. They want to buy in a structure based on the country they probably came from. I'm going to use an example of this. There's a certain part of the country where people will come and rent here for a year. Then 2 or 3 families will buy one home. They'll pay down that mortgage as quickly as they can, and then those 2 or 3 families will buy 2 or 3 more homes. So everybody owns their own home. Fantastic, smart way of buying real estate if you're willing to live with your relatives. But that's what immigration does. So immigration drives a housing market, the ability of a housing market to get bigger only to a certain degree. Then you have birth rates. Well, we know the Canadian birth rate has been next to nil. We know that immigration has been next to nil. But we see home sales being reported as sold and sold and sold. The reason they are being reported as sold and sold and sold is because they're still comparing it against a real estate market from a decade before, the size of a market that was a decade before. When you compare it to today's market, you see that the real estate market is actually 20% slower.
Ross, could you maybe again repeat the website people can check out to see what their house might really be worth?
Okay, so home value index, currently, you have to understand, we are only going to go live when we have numbers that we can support. So the home value index right now, we have not posted provincial numbers, but that could be released within the next 2 weeks. Right now, we are comfortable with our number for the national number. So that is homevalueindex.ca. So it's HOMEINDEXVALUE.ca. So any consumer can go there. They can look at our charts. They can see we've even broken it down. We've supplied charts for how each province has impacted the national average price over time. They can compare the home value against inflation, because we've got one chart which shows the original 1990 price, and then if you just took inflation alone into account, what that price would be worth today. And then you also have the chart where it's clear on its own and it's interactive. You can put your cursor to a certain point of the line, and it will tell you what the value we have recorded on that date. Now, what I will tell your listeners is this. Our methodology for doing this is based on how standard appraisals are done. So our methodology means that the more ability we have to appraise more and more categories of homes, odds are the index values are going to drop. Because when you separate the housing stock into the way it actually exists, you have to take, you can't let it be weighted for 100 condominiums and 200 single detached homes when in fact there are only 150 detached homes and there are 250 condominiums. You have to adjust the price that way. So we're going to leave the home value index the way it is until the end of the year. So you can use it consistently from now to the end of the year in your readings. When we update our provincial averages, we will announce it on the website so there's no confusion. So the consumer is not going to be misled at any time if they use the home value index.
Thanks to our guests, Victor Adair and Ross Kay, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.